everybody, and welcome to the Q4 2019 webinar on the AJ Bell Managed Portfolio Service. Hope you all had a very enjoyable Christmas and New Year, and we'll take the next 20 minutes or so just talking you through what has happened in the fourth quarter, and indeed a little bit of a review in 2019, and trying to look forward as to what we think might happen in 2020. So let's race through this and get started. One thing we are going to introduce today in this session we haven't done before is a review of MPS performance. So we'll show you the performance numbers of the different MPS strategies, as well as some of the changes that have taken place in the portfolios over the quarter as well. So we're conscious that each time we do these, there are new people listening and joining, and new investors that have come into the MPS. So thank you for that. So apologies for those of you that have seen this slide before, but we like just setting the scene and reminding people where we are as a business. So now we're managing over 450 million for advisors through our investment solutions. So thank you very much for your support. It's very, very welcome. And as a reminder for those of you that are new, we've got a range of passive and active MPS, both on growth, on income. We've got Pactive MPS that we'll look at a little bit later on, growth funds, income funds, and indeed a newly launched retirement portfolio solution. So a very, very wide range of different investments, choices that are available for you and your clients. So as I mentioned, we wanted to, for the first time, show you in this webinar the performance of the MPS. And I'm not going to go through these numbers in detail, but they're there for your reference and to refer to when you need to. But what I wanted to say, well, firstly, is we're showing this performance here because we want to be as transparent as possible. So we put these performance numbers on our fact sheet every single month. And this is the first time we're adding them to the webinar. These are the passive performance numbers. What you can see there is a very strong 12 months, 2019, across the portfolios. Now, the passive MPS actually has gone through its 3-year track record, but I was keeping it simple in these numbers here today in the webinar. But it has got a 3-year track record. So for those of you that see that as an important factor in your investment process, then you can look at longer term numbers on our fact sheets and on our website. Now, looking at the active performance here. Now, active performance was launched just under 2 years ago, so it's coming up to its 2-year anniversary. Now, again, we've got I think a set of performance numbers here that we can be proud of. The 12-month performance is strong. It looks very good versus its peers. And what I would draw your attention to maybe is the income MPS, both income 1 and income 2, which have had a very strong 2019 as that income style has been rewarded for investors. So if both of these target a yield of 4%, and if that's something that is required by your clients, you've got income seeking clients, then do please take a look at our income solutions. Now, briefly mentioned at the start, we also have something called our Pactive MPS. So this is the beautiful marriage of both passive and active investing. So these are currently split around 50% passive and 50% active. They were launched in February 2019, so haven't quite got the 12-month track record yet. But over 6 months, as you would imagine, the performance is some way between the passive MPS and the active MPS. Pretty much where you'd expect to find it. So these give some of the benefits of active management, but also have an overall fee basis that's lower than the actively managed portfolios too. So getting on to Q4 and what happened in the markets, it certainly was a very, very strong finish to the year, as we can see at the right-hand side of this chart, where we've got equity markets rallying quite hard in the second half of December. Now, it was much tougher for bonds during Q4 here, and certainly gilts were very weak and was a challenging period for the gilt market as yields widened. At an equity level, perhaps unsurprising given the result of the election and perhaps some clarity in the political situation, it was the UK that was the strongest market across the world in the fourth quarter, and so we've got a return here of just over 4% for the FTSE All Share, but actually mid and small cap indices were even higher over the fourth quarter. If we just take a step to the side for one moment and look at the 2019 returns, I haven't got the data on a slide, but just to talk you through it, we had the S&P 500 index up 25% for the year, a really, really strong year. Now, Asia was actually the worst region for an equity market for 2019, but was still up 13% over the calendar year. Corporate bonds in the UK were up 11%, whilst property was up just 1.5%. And I'll come back to property in a little while as to why that's a factor that's played out well for us in the portfolios. So looking just a little bit more depth around what's been driving that higher, certainly a strong quarter, bringing 2019 to a very strong finish. Fixed interest was much tougher in the fourth quarter, but was still very much positive overall. And really, as we saw in the last chart, the markets rallied strongly from the 13th of December onwards as the UK election result was announced, a Conservative election victory, a strong majority for Prime Minister Boris Johnson, and that drove UK equities much higher, with domestically focused medium and smaller companies performing very, very strongly there. In the US, certainly we've seen a further rate cut in the US from the Federal Reserve, and that has pushed equities even higher. And also signs of what Donald Trump called a phase one trade deal with China. That was also very well received, and that helped Asia and the emerging markets also go higher, and indeed as did commodity prices as they moved up over the quarter, and those commodity producing countries in the emerging markets managed to grow strongly on the back of that. In fixed interest, we certainly saw mixed returns, with government bonds very weak as the risk on nature of the market saw investors move away from government bonds and yields move higher, and that indeed really did push high yield bonds sharply higher over the quarter to finish the year very strongly indeed. So digging down into some of the macro issues that have been going on and some bigger picture things as we do in this. So the currency market in sterling has really been the place where the volatility in the political and macroeconomic situation has been most exemplified over 2019. So this is the 2019 sterling versus US dollar chart, and we can see huge volatility and huge variation. Now, if we started the year at around 127. And actually, that sterling rallied about 5% in the first quarter of the year, and then fell 10% into the summer as Theresa May resigned, and it looked like it was going to be very difficult for any kind of Brexit deal, and then subsequently has rallied and then back 10% from that. So we saw a 5% rally, a 10% fall, and then a 10% rally in sterling versus the dollar over one calendar year. So significant volatility in that. And of course, we've got the FTSE 100, which is very sensitive to this exchange rate, whereas we've got the mid 250 index and the UK small cap index, which is much less sensitive to this exchange rate. So it explains why we saw such a strong move in medium and small companies in the UK in the fourth quarter, whilst the FTSE 100 was held back just a little bit. Looking to other areas, well, the S&P 500 has really had an absolutely amazing decade. So this is a 10-year chart of the S&P 500 in sterling terms, and we have got the S&P 500 up over 300% over that decade, actually more than double the next best global market, which incidentally was Japan for the decade. In the US, we've seen a huge expansion of technology over that decade, as we know. And interestingly, just as we were putting this webinar together, Apple hit an all-time high on the 2nd of January, very, very different to 2nd of January 2019 when it issued a profits warning. So we've seen the Apple stock rally very strongly, hit an all-time high, and now have a market cap of $1.3 trillion. Interestingly, over 2019, you've gone from profit warning to all-time high, and its earnings per share have actually fallen over that period. So a real re-rating of the stock. And it perhaps is just telling a story of what's gone on in the US and with technology, not just in 2019, but across the whole decade. Turning to China, well, we saw Chinese GDP growth of about 6% through 2019. And that is a rate, of course, that most developed economies would absolutely love. However, interestingly, when you look at China, 6% GDP growth was the lowest level of growth since 1992. Now, China's actually, as you can see from the chart, been slowing down pretty much year on year since 2009. And so a slowing China is perhaps not too much of a surprise. And indeed, China's GDP growth anticipated rate for 2020 is down a little bit further to 5.8. Now, given how big the economy is and has become, it is no surprise that the rate of growth begins to slow, or continues to slow, should I say. Certainly, we're seeing the trade war have an impact on that, and we're seeing the Chinese central bank give continual stimulus to the economy to help sustain the growth rates at around that 6% level that it would like. But of course, the Chinese economy is shifting from a very much an export-led focus to a domestic-led focus there. And so there is real change going on. And I think it's interesting when we look at this picture to think that China is around 50% of the MSCI Asia index. It's also around 50% of the MSCI Emerging Market Index. But it still is a relatively small part of the overall MSCI World Index. But I haven't got an answer to this question, but it does beg the question, what percentage will China be of people's portfolios at the end of this decade compared to where it was at the end of the last decade? I fully expect to see significant growth in allocation to China over the forthcoming years. Looking at Japan, this is a chart of Japanese retail sales year-on-year growth, and for most of it actually looks a relatively dull chart with not too much happening. But I thought it was really interesting to see what's just happened at the end of 2019 here. What we have in Japan is a pre-announced increase in the consumption tax that was coming in October. And we saw a huge spike in Japanese retail sales as consumers looked to buy goods they wanted to buy before the tax went up, before those goods became more expensive. And so we saw a huge spike in Japanese retail sales. And then we had the typhoon, the devastating typhoon that hit Japan. And then we had an enormous collapse in retail sales from a year-on-year perspective there, and then a slight recovery. So very, very volatile data coming out of Japan. I think interestingly, though, on Japan is its annual GDP growth rate to the end of Q3 actually came in at 1.7%, above expectations and certainly higher than it has been for quite some time. So perhaps some signs of life in Japan after all those years of enormous quantitative easing and Prime Minister Abe's approach to try and get that economy growing with some inflation. So that's just a quick roundup of what's gone on around the world and some of the key macro issues that we've seen that have been driving markets and politics and economies higher. Looking specifically at the portfolios, we don't go too much into what's gone on in the passive growth portfolios because they're a function of markets, of course, given the passive nature. As you saw earlier, all portfolios performed well over the quarter, delivering positive returns. Exposure to equities was very positive, given how much they moved higher, particularly in December. Fixed interest was a little bit more mixed, but we still managed to find some positive returns, particularly in high yield. Asia and emerging markets, strongly performing areas, given those trade deal hopes. And time will tell how that plays out during 2020. UK equities, as we've seen post-election, with strong performance, certainly a big driver of the performance in both the passive and the active strategies. And fixed interest, well, very much mixed returns, as we've seen, with gilt selling off where we have exposure to short duration, and that sold off much less than the broader market, which helped protect some of those returns, and high yield was very strong. So lifting the bonnet on the growth portfolios there, certainly some of the highlights that we've seen were Man GLG undervalued assets performing very well. So this has been at various points over each of these quarters either been a detractor or a highlight, depending on whether the value and domestic play is in favour. It was very much in favour in Q4, and so Man GLG performed very strongly. Value was also in favour in the US, perhaps for the first time in a while. So Dodge & Cox, our value manager there, performed pretty well against markets. Now, I mentioned property earlier on. Now, we make very few tactical asset allocation bets in these portfolios. One of the ones that we have in place in the active portfolios is to have a zero weight in physical property. Our universe is the UK physical property fund base. And we have foreseen problems in this area for quite some time and have had a zero allocation since these portfolios were launched in February 2018. One of the risks we saw was liquidity, and I may have talked about this in previous webinars, and certainly have written about it in the quarterly reviews. And actually, M&G during the quarter has had to suspend due to liquidity problems, withdrawals out of the fund and not being able to sell property fast enough. So it's exactly the issue, the risk that we saw has come to play. And therefore, I feel that we have been justified and vindicated in our position in not having any exposure to physical property in the active growth portfolios during the quarter. In fact, well, of course, now for nearly 2 years. In the passive portfolios, the universe is different. They have exposure to listed equities, and they do have exposure, and they have actually performed pretty strongly. Just looking at some of the detractors over the quarter, well, really, this is a case of our lower beta plays lagging a rapidly rising in market, which is in many respects exactly what we would expect. So the likes of Trojan Income lagged the market. That's perfectly reasonable and in line with our expectations. We have no problem with it lagging in this type of environment, and in fact would actually be concerned if it outperformed in that type of market, because it shouldn't do. Even load Global Income is another that underperform broad markets but outperform consumer staples, which is in the portfolios as a proxy of, again, perfectly in line with expectations. And just on the fixed interest side, we've got some passive exposure to some short-dated US Treasuries. They were weak over the quarter. These are unhedged and therefore have been hit by the strength of sterling. In previous quarters, they have been performing very strongly because they've been helped by the weakness of sterling. And it just shows the diversifying nature of this holding that it brings to the portfolio. On the income side, we have seen some very, very strong performance for 2019, as you saw right back at the start. Their strong performance from equities and fixed interest over the quarter, even though the income style underperformed broader markets. So we saw pretty much positive absolute returns from our equity income investments, but they did lag the market, again, pretty much in line with expectations. Asia and emerging markets over 2019, the income style here has been very, very helpful indeed. So in the active portfolios, our exposure to the likes of Jupiter Asian Income and JP Morgan Emerging Markets Income have been very strong performers. And indeed, if we look at the UK equities, Montanaro UK Income, which is a smaller companies income fund, was the big winner in the fourth quarter, up 15% as small cap rallied post the election. That holding actually over the year, over 2019, has now delivered a total return of 34%, significantly outperforming the UK market. So there is pockets of excellence in active management that we hope we can find and bring strong returns to these portfolios. Within fixed interest, we've mentioned strong sterling holding back unhedged bonds, whereas our UK-focused investment grade and high yield perform well. And we've mentioned property equities did perform very strongly post the election there, and that helped the income portfolios where those property equities are held, both in the active and the passive portfolios. And international property, which in the last quarter was a big winner because of currency tailwinds, has now become a laggard due to currency headwinds, just showing how much this currency move that we talked about earlier on can impact the portfolio. So just turning to recent portfolio activity over the quarter, well, actually a pretty big development in the passive market in Q4 was that BMO, a reasonably sized player in the ETF market, announced that they were actually closing all of their ETFs, which came as a little bit of a surprise to the market. We had some exposure in the passive strategies to these. So in the growth portfolios, we had exposure to their global high yield ETF. Now, on the basis that is closing, we have taken the action to remove that from the portfolio and replace it with the iShares Global High Yield Corporate Bond ETF. Then in the passive income portfolios, we had the BMO Emerging Market Income ETF, and that has now been replaced with the Vanguard FTSE Emerging Markets ETF. So we've taken some action there, given the news from BMO that they were pulling out of the market. In the active and Pactive portfolios, just one change to report, not a manager change there. We've been very happy with the portfolio and its component parts over the quarter. But what we're always doing is trying to get exposure to cheaper share classes and bring down the cost of investing. And we're very pleased to say that over the quarter that we managed to get exposure to a cheaper share class for the Fidelity Money Builder Income Fund. And that's the benefit of the active growth and Pactive portfolios. So new investors, since we secured that change, will have been invested directly in the cheaper share class. And we are currently going through a process of switching over investors from the more expensive share class into the cheaper share class at the moment. So you may have seen that go through on your client statements, or you may be about to see that go through on your client statements. So we're coming to a close of this quick run through the fourth quarter, just really to look ahead, or look slightly back and ahead. 2019 was clearly an exceptional year for equity markets and indeed fixed interest markets, really bringing to a close an incredibly strong decade for pretty much every type of asset class. Certainly in the end of Q4 in 2019, we've got an element of clarity in UK politics that has helped markets, but we are acutely aware, as I think all investors are, that the tension will now turn to the trade deal negotiations. Prime Minister has set a very ambitious timetable to get those concluded this year. And we will see how that progresses. But we certainly think that could lead to volatility in UK-based assets, so in sterling, in gilts, and in UK equities as 2020 runs through. So that's something that we're keeping an eye on. Global growth certainly remains supported by central bank action. We've seen that from the Fed and the ECB, and indeed the Bank of Japan and Bank of China through 2019. So 2020, a lot of focus is on how these trade talks will progress between the US and China. Now, clearly, since we've written this presentation and put it together, we've had the US action in Iraq in the assassination of a key Iranian official, and that has certainly seen markets react and commodity prices, and particularly oil and gold, push sharply higher. So we'll see how that plays out over the next few weeks and months. But it's I think a stark reminder as to how fragile some of these global macroeconomic situations are, and how politics is so interwoven with the prices that we see of assets around the world. Now, with low interest rates and inflation around the world, there's little sign of significant interest rate increases. What we are seeing is central banks talk a lot more about fiscal stimulus. We saw it in the general election campaign with both Conservative and Labour talking about spending a lot more money, particularly on infrastructure. We've seen the ECB make similar statements as well, and the new head of the ECB, Christine Lagarde, saying that she expects governments to spend more on infrastructure in their areas. So it may well be something we see pick up pace in 2020, and we could see the yield curve steepening as a result of that, which will be interesting to watch how that plays out in fixed interest markets. So lots and lots of things going on in 2020 to keep an eye on. Now, just as a reminder, one of the things we update our asset allocation on an annual basis. That asset allocation update is implemented in February. So we're working through that process at the moment. So look out for communications, really, I would say, in late February as to the changes, the long-term changes that have been made to the portfolio there. So we'll communicate that to you via all of the usual channels. And of course, there's lots and lots of information and articles and fact sheets and performance numbers available on our website. So do take a look there if you need anything, or indeed contact one of your usual AJ Bell contacts. We would be delighted to hear from you and happy to answer any questions that you have. So that's all I wanted to say today. Thank you very much for tuning in and listening to this update. The quarterly reports, the written reports are available that support this webinar. So if you want a more in-depth look at what we've been seeing and what we've been doing in the portfolio and what's been performing well or not so well, then do read the written reports to support this. And we look forward to speaking to you again soon. thank you very much for listening.